Hey everyone, in this video I wanted to highlight one dividend stock that's down 46% off its high that I think you might regret not buying on the dip. And that dividend stock is eBay. So I'm going to highlight some of its financial metrics to substantiate why I think it's a buy right now. Starting with, of course, the dividend yield. When you're talking about dividend stocks, it's hard to ignore the dividend yield. That's what many passive income investors pay attention to. eBay only recently started paying a dividend, and already the company boasts a dividend yield of 2.24%, and it would be reasonable to expect eBay to increase its dividend per share payout over the next several years and perhaps over the next several decades. Looking at eBay, you're not going to see a company with strong revenue growth. This isn't going to be a company that's going to grow revenue by double digits and higher over long periods of time. That's not the business model for eBay. eBay is more of a slow growing company that operates with high profit margins. And so you could see eBay's revenue here up and down. There's been some acquisitions and divestiture activity, overall ending with 9.94 billion in revenue in the most recent trailing 12 months. One other thing to highlight is eBay has focused, like I mentioned, on profitable growth, and so it stopped sending these promotions and incentives to some of its users, which led to a decline in user activity and a decline in monthly active users. Although the good thing about that is that eBay is going to operate with more profitability. And speaking of profitability, what I have pulled up here is eBay's operating profit margin over the trailing 12 months. And I have this figure going back a decade. While there is some volatility in this metric, it has been above 20% for the entire decade, and it's reached as high as 35%. So you've got a company that operates with strong profitability. And I say strong because if you compare eBay with Amazon or other e-commerce companies like Shopify, maybe, you're going to see eBay has much stronger profit margins than those companies. Amazon is a more capital intensive business. It owns some inventory. It also handles shipping and logistics, which is very expensive and brings down its profit margin. eBay doesn't do that. It leaves the inventory to buyers, and it also leaves shipping and handling to be communicated with buyers and sellers. And so that allows the company to operate more profitably, even though it may be sacrificing growth in order to operate with higher profit margins. Finally, the last reason why I'll give for why I think eBay is a stock you might regret not buying here is the cheap valuation. eBay is trading at a forward price to earnings of 9.7, relatively cheap, almost half the average stock in the S&P 500 when you're comparing with the forward price to earnings ratio. So yes, you're not getting a company that's growing fast, but you're also not paying a growth stock valuation. You're paying a bargain stock valuation, a value stock valuation for eBay stock. So, for all those reasons, I think eBay is one dividend stock that you can buy on this dip that I think you might regret if you miss out on. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.